Welcome to the live stream. It was an interesting day on a Monday. Last Monday was phenomenal. We had huge appreciation in one day. Boy, was it fun. But today, the market opened up negative because we had the bad Moody's rating on US debt. So that caused more concern and fear in American debt, which might lead to other factors or other negative stories. So the day started on the negative, but some stocks really rallied back. Microsoft was in the green pretty much the whole day, and it ended up 1% higher. Nicely done. Amazon started off in the red, ended up in the green. Google, ditto. It started off in the red, ended up in the green, and Meta just squeaked a tiny gain. Interesting. Now, healthcare did do well, and it's great to see United Healthcare bounce back 2 days in a row. Really nice returns. And that goes to show that the stories around United Healthcare were just way too negative, way too negative. It's good to see them bounce back. There's just too much value. That was an obvious good opportunity for investors who bought on Thursday or Friday morning, which I did. I'm up on the stock, I don't know, 12, 13% in 2 days. I wish every stock was like that. I wish the market would discount stocks every day like it did United Healthcare, obviously putting forward a company that's super valuable, super discounted, and becomes a really good play. I mean, I'll take it. 2 days of goodness over at United Healthcare. Good to see that. Those guys deserve a break. And then another stock that's been rolling is Adobe. Have you guys noticed? Week after week, Adobe's getting it done. Finally, this really valuable stock is heading upward and onward. Nicely done, Adobe. The healthcare space has had 2 consecutive trading days. Very good. 2 good days of upward appreciation on stocks. That looks really good. Consumer staples, with all the fear going around, hey, some people bought some tobacco, some Procter and Gamble, some Costco. Why not? Energy had a terrible day. And then the defensive stocks, they had a good day. So that looks good. Financial services, mixed bag. JP Morgan down 1%. Berkshire was down a little bit. Citibank was up a little bit. So it was a mixed day. It's some red, some green. It's all over the place. No real big trend like, hey, this is really working or that working. But let me tell you, from where we started to where we ended, I'll take it. I will take it because we started the day way in the negative. And just intraday, the NASDAQ rallied 1.3. I'll take it because I thought it was going to be a nice red day, but no, it ended up being mixed. My portfolio pretty much broke even today. It wasn't, if I probably lost $100, but it's a big portfolio. So I'll take that, especially since we started so deep in the red. So that was encouraging that, hey, investors want to be invested in equities. They don't want to buy into the fearful stories. I mean, the media stories, they need stories they can cling to for like a couple months. Oh, this is going to be a problem. Let me scare investors so they can keep coming back and listening to our shows. And you know what? The information was delivered. I think the Moody's downgrade of U.S. debt is a bad event. It's bad. Interest rates did go up. Bond prices fell. It was a good day to buy bonds. I ended up buying bonds today. If you want to know what I buy, become a member. I publish it out to members in videos. I do a couple of videos a week just to talk about what I'm investing in and the reasons for it. And, if you'd like to know, jump in and become a member. A member like Mike, the dividend investor guy. And I probably communicate with Mike, I don't know, 20 times a week, which is great because he's got good ideas. And we are kind of in this together. You ended up 0.49% to the upside today. That's a very good day considering everything that was going on. So congratulations on that. Hopefully you start a rally, you start to roll and make some money. Looks like some other people have joined the live stream. Looks like Carlos is on. Very good to see you. You opened a position on United Healthcare on Friday. Nicely done, sir. I bought more United Healthcare early in the trading session today just because I'm like, this thing's going to keep rolling. And I bought when it was up maybe 3%, and it ended up going up 8%. So, man, my career in day trading may be around the corner because I made 5% on United Healthcare. The only problem is that I dollar cost average. So it's not like I made a ton of money, but I'm buying into a stock that's headed in the right direction. Neil, good to see you, man. Very good to see you. Robinhood's up VG. I don't know what VG means. You guys got to spell it out for me. I'm 56. Some of you young guys use like some short abbreviations, some acronyms, and I don't know what you guys are talking about. So you'll need to make it easy for me at times. So Robinhood's up. Oh, man, beautiful. Up 4%. Robinhood is rolling, baby. Up 72.5%. And this stock really has a great story. I love their story. So that's why I started investing. They have the right fundamentals and the right story. And I'll continue to own Robinhood. This is my number one percentage gainer in the last 12 months. And they will probably be eclipsed by one of these stocks, A-Lab, which it looks ugly year to date, but you got to really know how to look at the stock, which is the market really discounted this stock. And if we look at the year to date, yeah, it's down, but look what it did. It gave us a really nice acquisition price, and now it's up 70%. Thank you, stock market. Boy, you're giving us discounts left and right. I appreciate it. And you make it really obvious too, stock market. You make it obvious that everybody loves this stock because they have a terrific product growing tremendously, 200%, growing 200%, profitable cash flow, producing what's there not to like. So the market loved it, and then the market hated it. Well, hey, whatever you hate, market, that looks really good from a fundamental perspective, I like, and I bought it. So I think this one might take the title for the next 12 months, or Oscar Health might take the title. They may get in the cage match with A-Lab and say, wait a second, you're cool and everything, but we're going to take the title this year because this stock's really rolling. This is another high growth stock, making money, generating cash flow. So these stocks are some of my favorites, not because I have the most money in them, but because they have great businesses, make a lot of sense, great fundamentals, great upside. So Oscar Health, remember that name. And of course, Uber, but Uber is not going to go as fast and furious as Oscar or A-Lab. We'll see how it turns out. Rex, good to see you, man. You were up 1.44. Nicely done, sir. That's what I'm talking about. Android PC, what's up, man? You were in the morning session. You're doubling down. So is Mike. Good to see you, Mike. So let's see here. That's very nice of you to say, Mike. I appreciate it. And just right back at you, you bring a lot of value to the community. So I think as we kind of collaborate, I'm getting a ton of value. So I just love like the community and getting the ideas. Like A-Lab wasn't my idea. It came up in a live stream, and then it came up in member calls. And then I've made money on Instacart. A member, recommended that stock. And I bring recommendations to the table as well, or I should say ideas to the table, and then we analyze them. But that's the power of having a really solid network of people and being a part of a community that we're really are advanced investors, and we want to dig in on investments, find the good ones, and then, bring up good ideas for one another. So it's great to have you, Mike, in the community. Thanks for bringing it week after week. And Rex, great to have you. You're a newer member. Thanks so much for your support. Glad you had a good day. And there's my man, Tony, checking in. Good to see you, Tony. Good to talk with you. Yes. Was it yesterday? Yeah. Yesterday we had a great call, member call. Great to see you there. So, very good. Good. Thanks, man. Sometimes, I can figure out big math problems, but can't figure out how to tie my shoes. I appreciate that, Mike. All right, so let's keep rolling here. I have 4 stocks that are already on the list because members kind of gave me these symbols. Symbols are DKS. Next symbol is BLBD. Next symbol is BGC, and then LNTH, Lanthium. I'm going to review those in their entirety, but I wanted to take a quick tour and see which earnings were announced today. And I know some smaller companies. I was curious to see what Trip.com had to announce because I own Airbnb, and I am curious to see how the travel industry is doing. And then this one here, this is a technology company. We looked at this one in the morning live stream. My conclusion was it wasn't discounted. It was actually priced at a premium. So I will pass on that one. But I wanted to take a look at this guy, and then Agilsys. I want to take a look at that guy. We looked at Zim. Zim looks good, but you got to buy it at the right times and have a good exit strategy. We reviewed that one on the morning stream, and that was my conclusion there. And then Yalla Group, what do these guys do? Let's take a look. Bushy 1147, good evening, sir. Thanks for joining. Good to see you. And if members, if you want to see other stocks, please put them on the chat. We'll take a look. So let's take a look at these stocks real quick. So Trip.com, they announced after the market closed. These guys are a $44 billion market cap company. It looks like they're not moving the needle in after hours. So maybe the market isn't overly excited. And that is interesting. These guys, let me take a look at their website real quick just to get my head around what they do. So Trip.com, and I think they're going to tell us which brands are a part of. So the brands they have is Trip.com. Man, you know, I don't use a lot of travel sites. I usually, if I'm traveling on business, I'm a Marriott guy. And then if I'm traveling with my family, I'm an Airbnb guy. And then with airfare, you know, I love a couple airlines. So I don't use a lot of travel sites. This one here, I haven't heard of these, Trip.com. Maybe you guys have. So, but we know what they do, right? If you want to take a trip, travel, book your hotel, book your airfare, rental car, experiences, and so forth. So these guys are $44 billion in market cap. It's a $7.3 billion revenue company. So you're paying less than 6 times revenue, right around 6 times revenue is better stated. PE ratio is a little under 20. Forward PE is 19. Analysts think it's discounted by 17%. Over the 1 year, they're up 18%. That's not bad. Year to date, 2.27. Not a big surprise because I think we've had a couple of, you know, periods of time when we had a lot of bad news around the economy. Hey, the consumers pulling back. They're not going to be traveling as much. So that kind of makes sense to me. Being down 2.27, you know, that's kind of makes sense. If you looked at Airbnb, I don't think Airbnb is doing much better than that. So that is kind of what I would expect. Now we'll take a peek at their earnings and see if they have. Yeah, here we go. Let's take a look at their earnings report and see what they had to say. See if we can draw any useful pieces of information that tell us what's going on. So these guys are in Singapore. Oh, okay. Maybe this is an Asian play, huh? So they're in Singapore. So international businesses continue to demonstrate robust growth. Okay. Inbound travel bookings surged 100% year over year. Wow. So are people in Asia really traveling a lot? That's why I hadn't heard of those websites, I guess, because they really focus on Asia. And I mean, that's a big marketplace. That's a humongous dark marketplace. So they have, and I can look at this on Stock Analysis, but I wanted to see their revenue growth. And maybe Stock Analysis already has it. Let's see if they have it. No, they don't. See how their quarter they just closed should be end of March, and these guys just have December. So let's go back to the earnings and see if I can look at revenue. So here is the revenue, and they are in Asia. So we have, this is quarter ended. So they're going to give us sequential and then year over year. So total revenue. So year over year, you're at 11.9, and this is in this currency. And they went up to 13.8. So that was about, call it a 2 billion increase. And if I do quick math on that, that's about a 18% increase. That's good. The quarter is 1.9 billion in revenue. So these guys are not small. They're pretty substantial. And sequentially, they are growing as well. So that looks good. Sequentially, they're growing at like 8% or so. So that's looking good. Revenue growth looks good. Revenue growth tells me, are customers liking trip.com? Are more customers finding the site and using it? All those things are what the top line revenue tells me. Is the business attractive to consumers, customers? Are more customers wanting to be doing business with these guys? So that looks good. Top line revenue looked good. Okay, now net income, they are making money. That looks good. And that's all they're going to show us. They're going to show us the balance sheet and the income statement. So mission accomplished. They are growing nicely. Nice growth on the top line. Now, why is the market not liking that report? Maybe it's because it's a Chinese stock or a Singapore stock, excuse me. That might be it. Now, I'm not ready to invest in a Asian travel site because I'm already in Airbnb. I invest in China through an ETF, as well as I own Alibaba and I own Futu. This one here is going to be somebody else's investment because I just don't want to get too deep into Asia, especially with companies that will be hard for me to track. But this one was the highest market cap company that announced today. So I wanted to take a peek and see what they were about. It's good to see that their travel is doing well. Looks like travel in Asia is, still going on. So it looks good. Looks good. So that was Trip. Let's take a quick look at Qufu Technology. With its subsidiaries, operates AI-powered credit tech platform in China. Man, another Chinese stock. Okay. 6 billion in market cap, 2.35 billion in revenue. Very low PE. Interesting. And it's down in after hours. All right. What happened? Now, I'm not going to dive deep onto this one. This one is interesting. It's AI. It's in China. It may have a solid business. Let's look at historical revenue growth. See, this doesn't, give me a lot of confidence. If you're an AI company, if you're a technology company, and the consumers find you exciting or partners find you exciting, your revenue is going to be growing. It was growing nicely for a while, and then they hit a wall and stopped growing. So what happened? That's not good. There's the most recent quarter, or I should say the fourth quarter of 2024 was negative. That also is takes away some of the confidence. So this one here, again, will be somebody else's investment. I'm primarily a U.S. stock-based investor. What I do have some investments in China, in Latin America, Europe, but I don't want to get too far out of my home country. And Canada, I invest in Canada, and as well as in Mexico, a little bit in Mexico, a little bit in Canada, predominantly in the U.S. So that's interesting that they announced a couple of Chinese stocks announcing today. And then this one here, Agilysys. So these guys are marketer software for hospitality industry. Okay. And these guys are not doing anything in after hours. So not very exciting stock. And they sold off today. So I think there's not a lot of positive sentiment around this stock. They are growing nicely. That looks good. I'm not familiar with these guys. So they do technology for hospitality. Now, if hospitality is going to struggle, so will these guys, because companies like hotels and stuff, they won't spend a lot of money with those stocks. All right. So that's the earnings were not all that exciting today. Some smaller companies. I think tomorrow it's going to get a little more exciting with Home Depot early in the morning. So we can cover that in the morning. And I think tomorrow we have the member call. So I won't be streaming in the morning. I'll be just talking to members in the morning. We can talk about Home Depot. In the afternoon, Palo Alto. Viking Holdings. Do these guys do the Viking ranges and stuff? I'm not sure. We'll have to look at it tomorrow. And these announced before the market opens. Elbit, Amer Sports, Toll Brothers, a home builder, is going to announce tomorrow after the market closes. Pony AI. Take a look at that AI company tomorrow. So tomorrow we'll have one humongous name and then two humongous names because Palo Alto is pretty big. I've been a little bit of a bear on Palo Alto, thinking they're a little too expensive. We'll see. We'll see how they do tomorrow. Good luck to Palo Alto. All right, let's catch up on some comments. Then I'm going to get into some of these stocks that people wanted to see based on the comments that I got throughout the day. Let's see here. So Bushy, I sold my Zim position. Nice. Congrats, man. Nicely done. Yeah, Zim is a roller coaster, man. It is not a smooth stock. It goes up and down. And that's good. If you know when to buy it, you can buy it at the right times and just have a good exit strategy, collect your winnings and move on. NASCAR All Out. Thanks so much for joining. And interesting. Tony, I'm personally thinking, okay, so you're thinking of holding Zim throughout the year. Good luck. It has been going up. I know when we looked at it this morning, it was going up. Android PC. You're not a fan of Chinese stocks. I get you. And then Dudu Prado. How about Everix? I've never heard of Everix. And then Bushy. I'm probably going to stick to some shares. You'll pick up some shares in Zim. Kind of like wait for it to come back and then do it all over again, huh? That sounds like a good plan. Know how to invest in a particular stock, and there's no rule against making money on stocks a few times. No rule at all. That kind of stock, I totally agree with it. Now, if you have a stock that's like an Uber-like stock where I think it's just going to be worth a lot more in the future, I'm going to stick around on an Uber. I'm not going to, buy, see a big gain, cash it out, and then try to come back because I think Uber is just going to keep elevating in value. But on a Zim, I totally agree. There's some stocks like Zim where I get in and then I get out and collect my winnings and wait for the time again where I see it set up really well, go in again and make some money. So good luck. All right, Dick's Sporting Goods. They announced they were going to be acquiring Foot Locker. Now these guys announced on May 28th. So we got a couple weeks. No, that's next week, right? Next week, call it a week and a half from now, we're going to be seeing their earnings. And these guys, this is retail. Now I got to like put my preferences out there and my biases out there before we get into it. I don't like retail. I don't like retail because it tends to be good one year and bad the next. It tends to be industry where you got to hire a lot of employees, lease out a lot of expensive real estate. Your margins are tighter. But let's take a look at what we got here. You're paying pretty much 1-to-1 when you go look at the market cap and revenue. Now, Dick's is kind of an upper scale kind of athletics, sporting goods. You get really nice footwear there. If you're going to play a sport, they got premium equipment there. So the PE for the current year is 13, and then forward is 12.5. The stock did sell off when they announced that they were going to acquire Foot Locker. I don't think the market liked it. Analysts think it's a buy, and it's discounted by almost 29%. The stock over the past year is down 6% over the 5-year. Wow, beautiful, 500%. did really well. During the times of COVID, I can tell you personally, I have a home gym, and it was really hard to find equipment. And these guys just sold out of all their inventory. So who would have thought of, who would have thought that far? But they crushed it during COVID. Then they had a couple years where it was kind of flat, but more recently, look at that. They really have gone up. Starting in 2023, they had a nice run going into 2024. Now, when we look at their revenue has been growing. Here's the years we had supply chain issues. Man, these guys are cleaning up. They really grew nicely. But since then, the growth isn't all that exciting. I'm not sure why investors are so excited about a retailer that's growing at 0.45% in a quarter. To me, that's like just survival, right? Now they're going to acquire Foot Locker. Hopefully that works for them. Now that's $13.4 billion in trailing 12 months. Let's take a look at their profitability and free cash flow. So free cash flow is lower than it was before, but they had a boom year in 2022. That's not going to repeat itself for a while. We were coming off of a pandemic. Supply chains were really lean, and inventories were empty, so they could charge whatever they wanted. They didn't have to discount anything, and people were just buying it. So long as you had an inventory, people would buy it, and that's what drove inflation, if you recall. So these guys are doing $509 of free cash flow in the last full fiscal year, which isn't all that exciting. I have to be frank with you. I think the business is worth about $5 to $7 billion minus debt. If you look at their margins, let's take a look at their margins. Gross margins, 35%. That's not all that great. Profit margin, 8.6. Well, free cash flow margin, 3.8. You could do better in T-bills. There's a problem when you can go with a very low risk investment like T-bills and make more money than this business. They have to take all the chance on buying the right inventory, opening their stores, hiring all these employees, and then just make less than 4%. That's why I don't like these businesses. I like businesses that make lots more money, like the businesses that I was highlighting earlier. So these guys are worth, I would say, $5 to $7 billion minus debt. Let's see what kind of debt they have. And they may need to, issue out more debt to buy Foot Locker. We'll see. But net debt they have is close to $3 billion. So that's not good, because now they're worth more like $4 billion, $3 to $4 billion in my mind. And you look at their stock, it's $14 billion. This is not a stock for me. I just don't like it. There's no barrier of entry. I mean, you think about Dick's. If you like a product, you can shop around on Amazon and find the product. You have all kinds of other retailers trying to sell product into these categories like footwear or golf or baseball or whatever sport that you're going into. So I just think that there's better investments for me. Although this one's gone up 500%, man. But I have my sphere of competence, my industries that I'm really good at. This one's not one of them. I have worked retail, like when I was a youngster and I had a job as a teenager. I worked at a retailer, understand what they're all about. Obviously I buy at retail. It's just not my favorite area to invest in. The closest I get is Kroger, which is a grocery retailer. That's very consistent. So Dick's is just a non-starter for me. I think it's highly overpriced, and I would not be surprised if we're sitting here 2 years later and it's worth $50 a share. I really think that's going to happen, because this is retail. I mean, if you want to see where capital goes to die, go to retail. You'll see where capital goes to die. Here's Macy's. They were doing all right a couple years ago. Now they're down 83%. That's where capital goes to die. And you can go retailer after retail. You look at Foot Locker, and Foot Locker is in one category that, I'm looking at the wrong one. Give me a second here. Foot Locker. I think this is the one that I want. So if we look at this one here, I mean, geez, it is not a good situation. Now they're getting a bump because of the acquisition, but Foot Locker was down 81.8%. That's what the market thinks of retail. So it's not an easy business at all. and it hasn't proven to be a big wealth creating industry. It hasn't. You got to find businesses that have great barriers of entry, monopoly like characteristics that can really have great margins, great cash flows, and just grow. And we looked at a couple earlier in the stream. A-Lab, Oscar, look at their margins, look at their growth, look at their cash flow, and that's what I'm talking about. So, Dick's Sporting Goods is a non-starter. I don't remember who asked about that, but I wanted to comment on that. Let's move on to the next one, which is going to be BLBD. This is Bluebird. Now, these guys were crushing it. They've come out with buses, and when everybody's crazy about EVs and AI, these guys were the right company at the right time, right? They went up 200% because they are producing buses that are EV powered. And it might be a really good idea because school buses, they take kids kind of around town. It's not like they're getting on a bus and going from LA to New York or something really long haul. No, it's usually these buses are, taking kids from within a school district. So they're driving maybe, 20, 30 miles. So an EV bus makes a lot of sense. And these guys are developing EV buses now, but they are also a traditional bus manufacturer where they have diesel powered, gasoline powered buses. And these guys here looked really good for a short period of time. Now they're really selling off. Now, do I think this is going to be a great business? The short answer is no, because it is a vehicle manufacturer. Let's take a look at their fundamentals and see if I should be reconsidering that statement. Let's take a look. Now, FYI, my brother who just retired, he was a diesel mechanic and loved diesel, loved cars and stuff. And he ended up managing the fleet of buses for a school district here in California. He did that for some time, just retired. And so not that I have the knowledge that my brother has, but I would just say that in working or talking to my brother about his job and stuff, he let me know. I actually asked him about Bluebird. This is about 2 years ago because I saw the business, just the stock going gangbusters. And I'm like, hey, give me the inside scoop on that. And he said, it's interesting, but they're really expensive. School districts can't afford to buy them. They're a really neat idea, but they're really, really expensive. So that's what I got from the horse's mouth. A guy who's managing a fleet for a pretty big school district in Southern California. All right, so here we got Bluebird. We saw the stock action. The last year wasn't all that great. It had its run because the market thought, boy, these EVs are going to be exciting. And in a way they are. It is cool to see that EVs are making it to the school bus category. Market cap's 1.3 billion, revenues 1.36, so 1-to-1 on sales to revenue, stock price to revenue ratio, price to sales ratio. I knew I was going to find it. And then we got current PE for the year 12.8 ratio, forward PE 10.3. Strong buy, but we've seen the stock really come down. So we'll see. We'll make our own decision here. Now, they did have a very good growth spur here in 2023. They had a contraction across 3 years. Look at that. Big contraction. Now, I think this is what fueled that run up, is that 41.5% increase in revenue. The market got really excited, and then we got 19%. But we're now dealing with government at the federal level that is really trying to reduce cost, right? No big surprise. We got what they call that. Forgot what Elon Musk called it, the dojo or whatever. So they were trying to find ways to cut costs. And I don't know that they're going to be funding a whole lot of, projects to help school districts, because that's more of a state or local item. And if there's going to be less funding to the states, maybe they don't have a lot of money left for buses. We'll see. But the growth is not great in the last 2 quarters. It's actually kind of slow, right? So we got 7.5% growth on the trailing 12 months. The last full year, that's pretty decent growth, 19% growth. But when you go to the quarter, it tells you a little more like, okay, they were humming along and then they hit a wall and they started to contract. and then they hit a slow growth period. So looking at where the economy is and where government spending is, I don't think they're going to get a lot of tailwinds, a lot of assistance in growing. I think they're actually going to see the opposite, which is school districts are going to have less money to spend. That's my expectation, high level. So they're growing at 7.5. Let's look at gross margins and cash flow. So first, let's look at gross margins, 19%. This is why I don't like vehicle businesses. Man, after all that effort to design the bus and put all the bills of material and order all the parts and hire all the employees to assemble that darn bus, you only make 19%. And that's higher than it's been traditionally. Traditionally, they're making like 10, 11% on their gross margin on their product, which is terrible. It's not very good at all. So their profit margin is 8%. Not very good. Not compared to, the technology communication services companies. This is not very good. And free cash flow is 6.44, 7% last year. So the free cash flow they're producing is 87 million. This type of business at their growth, maybe I go 15 times free cash flow, and that would be roughly about 1.3 billion minus debt. And the debt level for this company is, they actually have a cash surplus. So best case scenario for this company, they're priced fairly. And I would not buy Bluebird because I think that the chance of negative stories coming out and budgets being tight at the school district level, state level, that's probably pretty high. So this one here, it was exciting for a while. Maybe investors are thinking, is this going to repeat itself? Are we going to see this big rise? And I would say, we're not going to see that rise. I think this happened because they were coming out of COVID. There was probably a lot of funding. And now we have a different leadership in office. It's trying to cut back on spend. That way we can get that Moody's rating improved. And we're going to improve it by lowering our expenses and increasing our income. Increasing income means higher taxes. Decreasing our spend means obviously decreasing spend. So maybe they lower the amount of federal assistance to the states, which then ends up going into school districts. So if lower funding happens, these guys are going to have a hard time growing. So this, I don't think is going to repeat itself. I think this is going to continue to have this downward chart. And this stock's probably headed toward $25 a share or so. So that's how I see Bluebird. It's not a great opportunity. I don't like those margins. Just too complicated of a business. I think it's going to have some headwinds in the future. Let's move on to BGC. And then I'm going to check comments because I see some symbols out there. And we'll take a look at those symbols. So this is BGC Group. It's an American global financial services company based in New York and London. This was originally part of Cantor Fitzgerald, which was a firm that was in the World Trade Centers, a smaller firm, and they suffered big losses, when those planes crashed the Twin Towers. So this company has rocked up 221% over about a 3-year period of time. Very nicely done. And it's only $10 a share because there was a very low priced share. The market cap's 4.9 billion. Interesting. Are these guys going to continue to do that? Let's take a closer look. So BGC, and I'm going to take a look at their website just to kind of get familiar. What kind of financial services are they providing? So this is talent and technology. So these guys a technology company, or are they a professional services company? So they do full range of trade execution, dealer broker services. Okay. So they kind of provide their platform as a service, but they're not like a software company. They have the knowledge, the industry knowledge. They can provide that service, but they're not like let's call it like a Microsoft or an Adobe that's pure play. They're writing code and selling that code base to as many customers as they can. These guys are providing services within financial services. And a lot of that is just really knowing what their people need to do for the client. So, and we'll see that show up in the financials, and I'll point it out. This market cap's 4.9 billion, revenue is 2.25, so they're 2.5 times revenue for price to sales. PE ratio is a little high at 37.8. That is really high, but in the future, it's supposed to drop down to 8. It's a strong buy, discounted 44.5%. When we look at their growth, they have been growing. That growth looks good. And the markets have been doing well, right? In 2022, 23, and 24. I should say 23, 24, markets were doing great. And this year overall, right, we have had periods of really bad, stock depreciation, but then we've had moments where just the appreciation has been phenomenal. And we are on a month and a half run right now where it's been really good. So these guys make money when the market is really having a good time trading, making money. So that looks good. Now, will the times be as good as 2023, 2024? I don't think so, but I don't think they're going to be terrible either. Free cash flow is at $256 million in free cash flow. Let's look at their margins. So gross margins. So see how the operating margins and profit margins are really low. This is the distinction between a technology company and a services company. Here's Astera. Astera is the wrong example. Let's take a look at Adobe, because Adobe is a pure play software company. They write a piece of code and they can sell it to 1 million customers. They don't have to rewrite the code for each customer. They can just sell it to 1 million customers. Therefore, their margins are 89% because you wrote it once, you could sell it 1 million times. People download the product, they're good to go. So these guys just drive tremendous free cash. Look at this free cash flow margin, 41%. Beautiful. I mean, if you went to the bank and they offered you 30% interest on your money, you'd probably put a lot of money in that bank. It's like, yeah, pay me 30%. Thank you very much. So when we go to a company like these guys, you could see that this is a service-based business because they have to hire a bunch of people to provide that service. When you hire a bunch of people that are really qualified, well paid, there goes your profits. It's not like you're writing the code once and selling it to 1 million customers. If you have 1 million customers, you're going to have to hire 1 million employees to service those customers, and that gets really expensive. So that's the difference between a services company and a technology company that has those scale advantages. All right, so these guys are 256 in free cash flow. Their margins are not very good. So I'm willing to pay, I'm going to say 10 times this number, which gets me to about $2.5 billion in market cap value, less debt. Let's see if they have any debt. So it looks like they have a little bit of debt, about $652 million debt. So I think this business is worth about $2 billion and it's up at $5 billion. So no, thank you. This is done really well. Congratulations if you own this stock. I think it's done well, but just the fundamentals do not support this stock being higher. It actually points to this stock's overpriced. And earnings per share is a different animal than cash. Okay, cash flow is what Charlie Munger, Warren Buffett, Howard Marks, when they value a business, they look at the future cash flows of that business. Even the great Jeff Bezos, the founder of Amazon, he really focused on the ability to generate free cash flows in the future. That's how he built Amazon. And that's why they're worth $2 billion, because everybody knows those guys are just phenomenal. They've got great advantages and monopoly-like characteristics, and they're going to be able to drive free cash flow in the future. And that's why the stock's worth $2 trillion. Back to this business, just the margins are really low. I'm not overly excited about it. I think some investors did great. You could see that this stock was really priced low. Whenever you have a low price stock like at $4 a share, it makes me nervous. Like, why did it get so low? That's really a low price means lack of confidence. So I think the best is behind this stock, in my humble opinion on overall the stock, and looks like it's been having a tough time going anywhere from this point. It's just been going sideways. So that is BGC. That was a member request, wanted to cover it. Let's keep rolling. I think I've got some comments here with some new stock symbols. Let me try to cover those. So let's see here. So bear with me. I'm trying to catch up here. Looks like there's some good common action. Okay, so Bushy, you want to look at Enbridge? Let's do it. So Enbridge is an energy company, and Enbridge, together with its subsidiaries, operates as an energy infrastructure company. The company operates through 4 segments: liquid pipelines, gas transmission, gas distribution, and storage, renewable power generation. Okay. The stock over the 5-year up 40%. It really had a pullback along with a lot of energy companies. Actually, energy companies did well in 2022, and then they had a nice big dip. This one has been kind of rising lately. If we look at the 1 year, it's up 22%. Nice. And what I've seen, we covered another energy transmission company this morning. Forgot that symbol, but they also did well. And it's because they're doing well because you have a low oil price environment and you actually have a higher natural gas environment. But these guys aren't exposed to that commodity risk. They're just getting this energy product from one place to another and charging for it. So they have a more consistent um, revenue stream, and they just need uh, oil companies, energy companies to have the necessity to use their infrastructure, and that's how they make money. These guys are a big cap, $97.77 billion in market cap. Their revenue is 42.4, so a little over 2 times revenue for the company, price to sales. P ratio is 23.89. They pay a nice dividend, almost 6%. Now you can get 6% from Chevron, by the way. That's what I own, and I really think that's a really good dividend from a great company. So Enbridge is a nice, more stable than an oil company. It's done well for the last year. Let's see what the revenue has been telling us here. Now, the revenue growth leads me to believe that they probably acquired some businesses, unless the amount of oil and natural gas being moved just really changes. They had a couple of red years, and those years were years of contraction. I can understand the COVID year. That's no big deal. We did have like in 2022, oil prices were really high and oil companies really made a lot of money. Then after that, I think there was a contraction on the amount of oil that was being sold. So these guys really had their revenues go down, but now they've been really growing. That's really exciting, 43%. Now, I want to know, did they acquire a business or how did that happen? Because if it's all organic, that's super impressive, right? So let me see if I can get to their investor page and see if I can answer that question. So let's see here. Okay, so this is their investor page. And you can trade this up in Toronto or down in New York Stock Exchange. All right. So I'm going to look for the headlines and see when. So these are all their earnings. Okay, that's fine. Events and presentations. want to look at news. Okay, so I'm seeing if they have any acquisitions in the past. Acquisition. So here's an acquisition. It happened in 24. Acquisition. So here's another acquisition in 24. So when you have acquisitive growth, it may be a really good thing, but it's not the same as organic growth. So they did sell some of their assets. Okay. Here's a joint venture in the Permian Basin, which is in Texas. So they invested in that. And then one more acquisition. So they've acquired 3 acquisitions in a joint venture. And I'm not even done looking at the news. So this growth has been acquisitive. It's not as good as organic. So that's one thing to consider. Okay. Um, Having said that, it's still, let's see their profitability and cash flow. So these guys are generating $5.2 billion of free cash flow. It has been a little bit of up and down. The best year was 2023. And historically, there were, 4 billion or so in cash flow. And now they're at 5.253. Gross margins are pretty good for being in the energy business. That's pretty good. 42.5. Profit margin 9.67. Free cash flow 8.62. So when we look at this business, it's probably worth 15 times free cash flow, maybe 20. Let's go with like 18, which would make them about $100 billion market cap company minus debt. I'm curious to see how much debt they carry. Yeah, they carry a lot of debt. Whew, 70 billion. So that knocks off $70 billion of the value. Yeah, this is not my investment. This is somebody else's. Because you have $70 billion of debt. The way I view debt is if you wanted to buy this business, you would write a check for $97,770,000,000 and you'd buy all the shares. Then you'd have to turn around and write another check for $70 billion to pay off all the banks. Well, that is really expensive. That's an expensive stock because I'm only valuing their free cash flows at roughly best case 100 billion. So no, thank you. This is somebody else's. I get a better deal going into Oxy or Chevron. When we go into Chevron, this is a proven business, bigger market cap, 242, but it's not like Enbridge is like a small cap. It's $100 billion market cap, roughly. This one's been priced down over the past year. This one did do well around the 2022 timeframe. But look at this dividend, 5%. They can afford it. PE of 15, 18.5. Warren Buffett owns this business. They're not growing a ton, but they generate just gobs of cash, just big loads of cash. And when you take that cash and it's going to be there in the future, we're not going to get off, fossil fuels very quickly. It's going to take 30, 40 years. These guys are going to generate cash, immensely for a while. And that's why I think this is a very conservative investment right now, which is Chevron. They pay that dividend. If you want a little more risk with a little more reward, you look at Oxy, another Warren Buffett investment. And these guys, with low oil prices, revenue isn't growing all that great, but they produce cash and they're very well funded. They have good capital structure on their balance sheet and they generate good cash flow. They generate almost as much cash flow as Enbridge. What's their market cap? 41 billion. So Enbridge is up there around 100 billion. And here's Oxy. And if oil price begins to go, let's say oil price goes to 80, Oxy is going to be a super winner. Buying Oxy at the right time is really important. I started buying here, and I'm already up on Oxy. I'm making money on the stock. And I've got really good upside potential because, again, if oil prices rise, I'm going to be doing great on Oxy. So I'm accumulating shares. I think I bought more shares today because Occidental has really good risk reward situation. While oil prices are down, they're not going to stay down forever. I'm going to buy into Oxy. That's going to be where I grow within the energy space, and I'm going to hold my Chevron stocks. So that's my answer, Bushy, on Enbridge. Take a look around. I think energy has got some good value out there. Enbridge has been a popular stock, but that's how I see their valuation. Hopefully you found it interesting. All right, so we're going to go over LNTH, and then we're going to land this plane, and we can. So Lantheus is a healthcare company. They're a pharmaceutical company, and they have been beaten up. A lot of healthcare companies have been beaten up, but look at this volatility. It's like, geez, just falls off a cliff. And it's done it several times. It's like an EKG machine. Patients on their hospital bed or in surgery, and you see this EKG machine doing its thing every time the heart, pumps. That's what it looks like, and it shouldn't look like that. A perfect world, it goes up and to the right, nice and smooth. But we don't live in the perfect world. Let's see if this is a good opportunity here. So Lantheus has been a stock that I've owned. I've been in and out, and right now I'm out because I wanted to create some cash, and this was the stock that I sacrificed to get out of. I think has a very good risk reward situation, but healthcare has just been punished. It's been punished for a solid 2.5 years. This is a $5.4 billion market cap company. Revenue is 1.5. So you're going about 4 times revenue for the company. Price to sales. PE is 22, 11 PE on the forward. So next year, strong buy discounted by 71%. Wow. The revenue growth is there, although you see this number is getting smaller. So that is a little bit of a concern. We go dive into the most recent quarter. I think this is why the stock dove, is that you're basically flat at this point. You're not getting, when you compare Q1 compared to the Q1 a year prior, your business is kind of coming to a halt. So if we can see this grow, the stock's going to pop again, because they have good other fundamentals, like free cash flow is good. Gross margin, 63.7%. These guys do diagnostic med device items that they sell to hospitals and so forth. Their operating margin, look at the profit margin, 19.5. Remember Bluebird, the bus company? They were struggling just to go double digits. These guys are up around 19.5 on the profit margin. Free cash flow margin, 26.5. That's really good. So these fundamentals look good, but you got to grow this line. You don't grow this line, your stock isn't going anywhere. You have to keep this growing because you're a small cap, and small caps that are at a run rate of $1.5 billion of revenue per year, you have a lot of addressable market that you can take on. If you stop growing, it shows that your competition is beginning to stop you in your growth, or maybe they're taking some of your market share away. Those things are not good for a business. That means that you're going to be maybe stagnant on your revenue. You're going to be flat, or maybe you start seeing your revenue contract. Then it gets worse. So this one here does have a little bit of concerning news in the most recent quarter. When did they announce their earnings? They announced on May 7th. So we just got that information, about 2 weeks ago. We got to look at the next quarterly announcement and see what is going on with their financials. And if we can see this grow, man, this is going to be a really good stock. It's going to fly up. But if the next quarter is also 0% growth, then investors are going to be like, yeah, Lanthium is kind of, it doesn't have any momentum. It doesn't have the excitement that a lot of healthcare stocks have. There's stocks that are growing very quickly in healthcare that are small caps, and those are the stocks that are going to receive the capital going forward. These guys need to start growing. When I value the company, I see a big discount, but that discount was predicated on the company continuing to grow. And I would have to restate my expectations on Lanthium. And I'm not covering Lanthium anymore. What's going on? Yeah, I took it out. No, what happened? I thought I was covering Lanthium. These are all the stocks that I've done analysis on. And yeah, I'm not covering it anymore. So historically, I covered Lanthium, and I do recall that I had a nice discount on it, but I don't have any data on them right now. So right now, I would be holding. I would not be buying. I'd be waiting one more quarter to see where are they going to go. Are they going to grow again, or are they going to contract further, which would really scare me. So right now, I'd kind of hold my horses and invest elsewhere because there's plenty of opportunity in healthcare. There's a lot of discounted stocks in healthcare. So I would pump the brakes on Lantheus. So, Mike, that was for you, sir. Hopefully you found that interesting. And those are my comments on Lantheus. All right, everybody. So that was a good stream, man. I'm going to try to stream a little more often, and I'm going to try to publish when I'm streaming with a little more notice. Tomorrow, I'll be streaming in the evening. Tomorrow morning, I'll be having the member-only call in the morning. And if you want to be part of that call, you join the channel. Go to the homepage on my channel, YouTube channel. You click the join button. Get yourself signed up. Once you're signed up, you get invited to member calls. You get to use the tools that I use. You get all the valuations. I just published it today, and all the valuation and the research that I've done, I publish it out just for your access 24/7. That's another perk. You also, on live streams like you're seeing here, hey, you show up, you want to see a stock, I'd be happy to provide that to you. So it'd really be really nice to get some more investors in here so we can collaborate and find stocks that we want to invest in. So everybody, that is the stream for this evening. Let's see how this week plays out. Again, it was a day where the market came back. It started in the red, but it ended up being even. And in some cases, some of the guys on this stream made some money today, which was a big win considering we started at a really low point. So that was an awesome time with you guys. You guys have a good night. I really appreciate you attending, and I'll see you soon.